There's a story we've all been told. From childhood, we hear it from our parents, our grandparents repeat it, real estate agents advertise it everywhere. Buying a home is the ultimate sign of success. Renting is wasting money. You're paying someone else's mortgage instead of building your own wealth. Over time, this belief stops feeling like advice, it becomes part of who we are. If someone is still renting at 30, they often feel embarrassed, as if they're behind in life, as if not owning a home means they failed financially. Because of this pressure, people rush into buying houses they can barely afford. They stretch their income to the limit. They take on massive debt. All because signing a deed feels like making a smart financial move. But here's the reality. Today's economy is very different from the one our parents grew up in. Housing prices have changed. Interest rates have changed. Job mobility has changed. Yet the old belief remains unquestioned. And for millions of people, that belief is costing them financial freedom. The uncomfortable truth is this: a house is not automatically an asset. In many cases, it behaves more like a liability. It's often a highly leveraged consumption purchase, meaning you borrow a large amount of money to buy something you live in and then convince yourself it's an investment. If you feel pressure to buy, or if you already own a home but still feel financially tight, it might be time to step back and look at the numbers without emotion. Because wealth isn't built by following tradition. It's built by understanding the math. Today, we're going to break down the rent versus buy debate step by step. We're going to uncover the hidden costs of owning a home, the expenses that quietly drain your wealth and are financially no different from paying rent. We'll also look at one of the most important numbers in real estate, the price-to-rent ratio, a simple metric that can completely change how you think about buying. And most importantly, we'll explore how a disciplined renter, someone who invests the difference instead of stretching for a mortgage, can often build more wealth, enjoy greater flexibility, and experience far less financial stress than someone locked into a 30-year loan. But before we go further, we need to redefine something. What does throwing money away actually mean? When you rent, your monthly payment is straightforward. You pay for a place to live. That money is gone, simple. But when you buy a home, you're told your monthly payment is building equity, that it's basically forced savings. That sounds good, but it's not entirely true, especially in the early years. A large portion of your housing payment as a homeowner doesn't build wealth at all. It doesn't increase your ownership. It doesn't come back to you. These are called unrecoverable costs, expenses that function almost exactly like rent. Let's start with the biggest one, mortgage interest. In the early years of a typical 30-year loan, the majority of your monthly payment goes straight to the bank as interest. Not to your equity, not to your ownership, to the lender. It's essentially the cost of borrowing money. For example, imagine your mortgage payment is $3,000 per month. In the beginning, only a small portion, maybe a few $100s, actually reduces your loan balance. The rest is interest. That money disappears. In other words, you're not just paying for a house, you're paying for the privilege of borrowing the money to buy it. Next, there are property taxes. Even after you own the house, you continue paying the government every single year just to keep it. It's a recurring cost that never fully goes away. And in some areas, property taxes alone can rival what someone else is paying in rent. After understanding unrecoverable costs and the price-to-rent ratio, we now arrive at the most dangerous hidden factor in home ownership: opportunity cost. This is the silent wealth destroyer nobody talks about. When you buy a house, you don't just commit to a mortgage, you lock up a massive amount of money as a down payment. Let's say you buy a $500,000 house and put 20% down. That's $100,000. Now ask yourself, what could that $100,000 have done if it was invested instead? If you invested that money in a diversified index fund earning 8% annually, over 30 years it could grow to more than $1 million. That's the real cost, because when you buy a house, that money is frozen inside the walls. It's not compounding, it's not flexible, it's trapped. Yes, your house might appreciate, but appreciation is uncertain. Markets can stagnate for years, they can crash, they can underperform inflation. Meanwhile, the stock market historically compounds, so when you choose to buy, you are making a bet. You are betting that your home's appreciation will outperform what your invested capital could have earned elsewhere. And most people never calculate this. Now here's where things get powerful. If the price-to-rent ratio is high, meaning it's mathematically cheaper to rent, a disciplined renter can take the down payment money, the monthly savings difference, the avoided maintenance costs, and invest all of it. Over decades, that invested difference can grow into serious wealth. While the homeowner is tied to a 30-year mortgage, the renter has mobility, flexibility, liquidity, less stress, and potentially higher net worth. Because wealth isn't built by owning assets. It's built by owning the right assets at the right price. And sometimes, the smartest financial move isn't buying the American dream. It's renting it and investing the difference. Now let's talk about the most dangerous wealth killer of them all. The one nobody mentions at family dinners, the down payment. To buy that $500,000 house, you need around $100,000 upfront. That money doesn't disappear. But it does something worse. It becomes trapped. It sits inside the house as equity, but equity that produces zero cash flow. It doesn't pay you, it doesn't grow daily in your account, you can't rebalance it. You can't quickly access it without debt. It's frozen capital. Now imagine a different decision. Instead of locking $100,000 into walls and concrete, you invest it into a broad stock market index like the S&P 500. Historically, the market has returned around 8–10% annually over long periods. At that rate, money roughly doubles every 7 to 9 years. That means your $100,000 could potentially become $200,000, then $400,000, then $800,000 over decades. When you buy a home, you're making a concentrated bet. You are betting that one property in one neighborhood, in one city, will outperform the entire global economy. And history doesn't strongly support that bet. Economist Robert Shiller, who won a Nobel Prize, showed that over the past century, real estate prices barely beat inflation on average. Yes, there are boom decades. Yes, some cities explode in value, but long-term broad stock markets have historically outperformed housing in real inflation-adjusted terms. So here's the powerful alternative: rent and invest the difference. Invest the down payment. Invest the monthly savings between renting and owning. Invest the avoided maintenance costs. Now you're diversified, liquid, flexible, and compounding. That's how a disciplined renter can quietly build more wealth than a homeowner who looks rich on paper but is cash poor. Now let's talk about something even more underrated: mobility. In today's world, flexibility is a financial asset. If you get a job offer in another city that pays $50,000 more per year, the renter can move in 30 days. The homeowner, they're stuck in a process. Agent fees, closing costs, repairs, staging, market risk. Selling a home can cost 6–10% of the property value. In a slow market, you could wipe out years of equity just by moving at the wrong time. When you buy a house, you are locking yourself into a location for 7 to 10 years minimum if you want the math to work. You are betting your future self won't need flexibility. And in a fast-changing economy, that is a massive assumption. Buying a home isn't automatically wrong, but it is not automatically superior either. It's a financial decision, and like every financial decision, it should be based on math, not emotion. And here's the brutal reality. If you're wrong about buying, the exit cost is painful. Selling a home isn't simple. It's expensive, it's slow, and sometimes it's devastating. Renting, on the other hand, buys you something extremely valuable: optionality. And in a world that changes fast, optionality is power. Now I can already hear the biggest objection: but rent goes up, my mortgage is fixed. Yes, that's true. A fixed-rate mortgage is a hedge against inflation. Your principal and interest payment stays the same. But here's what people forget. Only the mortgage is fixed. Property taxes, they rise. Insurance, rising fast, especially with climate risk. Maintenance, labor costs increase, materials increase. That fixed payment argument ignores all the other costs that inflate every single year. You are not protected from inflation, you're just exposed to it in different forms. Now let's flip it. Yes, rent increases, but so do investments. If you rent and invest the difference, and your portfolio grows at 7–10% annually, it likely outpaces average rent increases of 2–4%. Your assets grow faster than your living costs. That's powerful. Instead of your house being your only major asset, you build a diversified portfolio that compounds in the background. And the spread between investment returns and rent increases, that's where renters often win quietly. But there's something even bigger than the math. Lifestyle. Owning a home is not passive, it's a responsibility. It's weekends at hardware stores. It's YouTube tutorials at midnight because something broke. It's stress when you hear a strange noise in the wall and realize you're paying for it. A home is a physical asset, and physical assets deteriorate. When you rent, you outsource that stress. Dishwasher breaks, you make a call. Roof leaks, not your financial emergency. You're buying time, you're buying mental freedom. And time freedom has value. Because time is the only asset you can't compound. Now let me be clear, buying a home is not wrong. For some people in the right market planning to stay long-term, it can make sense. But the blind belief that buying is always superior, that's outdated. The math has changed, the economy has changed, and the smartest move today is not emotional. It's analytical. Run the numbers, calculate the price-to-rent ratio. Understand the unrecoverable costs. Compare opportunity cost. Then decide, not based on pressure, not based on tradition, but based on math. Because financial freedom isn't about owning a house. It's about owning your decisions. Think about this. What if those Saturday mornings you would have spent fixing a sink or were spent learning a high-income skill, building a side business, improving your health, or simply resting so you can perform better during the week? Renting doesn't just change your housing cost. It can change your income potential. Because your time isn't being drained by maintenance. You're trading the pride of ownership for the power of freedom. And that trade can be incredibly valuable. Many people buy a house believing it will give them stability, but instead it gives them stress. A huge monthly obligation, unexpected repairs, market anxiety, and the constant pressure of being house poor. Now let me be clear, I am not saying never buy. buying can absolutely make sense. If you plan to stay in one place for 10 plus years, if you deeply value customization and control, if the price-to-rent ratio in your area supports it, then buying may be logical. But don't buy because society told you it's mandatory. Don't buy because you're scared of throwing money away on rent, while ignoring the interest, taxes, insurance, and maintenance you also throw away as an owner. A primary residence is first and foremost a lifestyle purchase. It's shelter, it's comfort, it's consumption, just like a luxury car or designer clothes. It is not automatically a wealth machine. When you treat your house as your main investment, you're building a portfolio that is highly concentrated, illiquid, expensive to maintain, and vulnerable to local risks. One bad neighborhood shift, one natural disaster, one market downturn, and your investment can stall for years. Real wealth is built through income-producing assets. Stocks, bonds, businesses, assets that pay you, not assets that you constantly pay. So don't let cultural pressure make your financial decisions. Don't follow a script just because it's popular. Run the numbers, calculate the price-to-rent ratio, add up the unrecoverable costs, factor in opportunity cost, and if the math says rent, then rent confidently. Invest the difference, build liquid assets, grow cash flow, and let someone else handle the roof repairs. Because the goal isn't to own a deed, the goal is to own your future. If this changed how you think about housing, hit like. If you want more strategies that challenge conventional wisdom, subscribe, and most importantly, make financial decisions based on math, not emotion. I'll see you in the next one.